Hey guys, and welcome back to the ASX Investor channel, and welcome to another CEO interview. Today we'll be diving into one of the companies in the lithium sector that we've featured before on the channel. It's Lake Resources. ASX LKE is a company that we're all familiar with. They're leveraging a direct lithium extraction process to produce a clean, high purity lithium product that's really going to help to feed into the EV revolution over the coming decade and beyond. Today we're going to be doing a broad-based discussion talking about Lake Resources, the Kachi project, future projects and upgrades as well, and also just talking about that pathway to production over this next period as we look forward to 2022 and beyond that. We're rejoined once again by Steve Promnitz, the Managing Director and the CEO of Lake Resources. Steve, it's always great to have you on the channel. Welcome back, mate.
Thank you so much for the opportunity, and thank you all of you for dialing in and keeping up to date with Lake Resources.
Before we dive into everything that's happened and all that we should be looking forward to, I think maybe it makes sense just to cast our eyes back to 2021, a transformative year for Lake as well as the broader lithium sector. Can you talk about how it's been for you and the company and what you've really thought about some of those big milestones?
Well, first of all, thank you. And first of all, on a macro level, we should go back to November, December of 2020. And that's when we first saw some firmness in the pricing looking forward for lithium. And so technical quality, we're looking somewhere around $4,000 to $6,000 a ton, premium quality anywhere from $6,500 to $9,500 a ton. Then we saw that jump in January, February, March, and over a period of about 6 weeks, it sort of jumped up to the range of $10,500 to $13,500 a ton. And this is interchangeable for quality lithium carbonate, lithium hydroxide. Now, in the last 2.5 months, we've seen that pricing lift to the $17,500 to $22,000 a ton. And if for your listeners to look out somewhere between late December and early January, you're going to see pricing of $40,000 a ton. So it doesn't matter what commodity or sector we're in, that is nothing short of spectacular. So on the back of that, all lithium stocks have behaved well. Lake Resources is no different. But as you know, what Lake Resources is delivering is something very different, not just leveraging that ion exchange technology. You talked about this cleaner, more efficient way of delivering lithium, but you produce a consistent high quality product that gets a premium price. You do that with an ESG benefit, which is what the EV makers are looking for. And because the process is scalable and efficient, we can come to the market more quickly than others and actually scale up to suit to become really significant. So look, it's been an absolutely transformative year. We did a capital raising in late January over a long weekend, and that was able to fund us right through to now. Then we did a bonus option issue in August, September, October. Most of the shareholders seem to like that. And so now coming towards the end of December, we're sitting on a cash position somewhere around 70 million. So we're well positioned to continue to deliver what we promised. And as you mentioned, a very exciting 2022 for Lake Resources and for the whole lithium sector. One of the things that is often lost in all the news that's occurring is that as we see almost daily comments about new expansions of electric vehicles, new expansions of battery plants, coming into Christmas, we've seen Toyota finally commit 35 billion to the EV transition. We'd already seen Volkswagen commit to about 130 billion euros to it. We just saw Ford commit another large sum of funds just to ramp things up in the eastern US for EVs. But despite all of that, we still don't hear that much investment in the upstream end for all of these battery minerals, and particularly lithium. Lithium isn't a scarce commodity, but it sure as heck is scarce coming into production. And the ones that are reasonably coming into production in the next 5 years, very little of that is uncommitted supply that doesn't have an offtake agreement. And I think for your investors to look at what those agreements are and what's uncommitted going forward. There's some real opportunities as we continue to see increasing in pricing.
It truly is a compelling pathway, as you mentioned, for those companies that can come online and bring production online moving forward. Maybe if we spend a little bit of time talking about or thinking about DLE, why have you gone for that process? We actually know it's a well-established process, but adapting it to lithium is the unique opportunity that Lilac has done. Can you talk about that technology and the benefits that you really see that will help to facilitate Lake moving forward with it?
Yes, whether it was clever or purely serendipitous, Lake has been focused on direct lithium extraction now for more than 3.5, nearly 4 years. And that's not because we were rocket scientists or somehow very clever. It was because when we spoke to the end users in 2017, 2018, Tool 1, they said, if you can produce consistent, high quality product, we'll buy it. And that meant low impurities more than anything else. And then separately, as you've heard from me before, myself and our technical director, Nick, had worked in Chile in the 90s, and there were concerns around water usage then in a hyper-arid environment, and we felt that we needed to do something that reduced water and its use. And so the benefit of Lilac is that, as you said, it's an extremely well-known water processing method. Ion exchange, I think I've used this analogy before, but in my corner cafe, we actually have water in the tank that's just town water, and inside is a little ion exchange column and a carbon filter so that you get fresh water. I mean, it's that common. It's just what Lilac did was adapt it for lithium. And so through that, we end up with a consistent high quality product that's low in impurities. We know battery and cathode makers want it. Because we do that, we can return virtually all of the brine back to its source, and we use a limited amount of fresh water. And I want to reiterate that there is some misconceptions that all direct lithium extraction processes use a lot of water. That on our studies is more around adsorption beads. Ion exchange beads do not use a large amount of water. If anything, it's probably less than other process water users. And in the process, we produce a high quality product that's got a very small footprint. Instead of 30 square kilometers of evaporation ponds, we've got something the size of a city block. So it's for those reasons we went down that path. And I have to say, this calendar year, when we're talking about transformation, this calendar year, for the very first time, we didn't feel isolated talking about direct lithium extraction, because there are more companies looking at it. There are other companies who are advancing along different methodologies. And I think it's going to be a way of the future, not one way, but a series of ways of extracting lithium directly from the brine instead of concentrating all of them through evaporation. To be honest, we were concerned 3.5, 4 years ago this was going to be a sunset industry, and I am still very much concerned that that's the case. And although we need all of these lithium projects, there's certainly going to be more money flowing to ones that produce a better ESG outcome.
And that leads us to the flagship project, the Kachi project. It's not the only project that Lake will potentially eventually develop, but Kachi is that first one. We know that the benchtop work's been done, the initial piloting, now moving towards potential demonstration plant. But what can we think about on the horizon for 2022? We know the DFS is up ahead, as well as the environmental study. Just let us know how that progression is going and what should investors really be looking forward to.
So you're absolutely right. The key things we have to deliver on are the definitive feasibility study, the environmental social impact assessment. That's so that we can get a production license. It triggers the release of the debt. It means that we can have financial close and get into construction. And I have to say that in addition to that, this calendar year, when we're talking about the transformation, one of the things that has transformed is that the equity markets opened. If we go back 18 months ago, myself and the chairman were almost essentially going around with a hat trying to get money to support us. And now the equity markets are open, and whether it's us or anybody else in the lithium space, there's been plenty of equity available. So it's available. The second thing is the debt. Debt is an absolute key. If you can source long-dated debt, which is a low interest rate, this is absolutely critical to both getting your project going and getting the next one going. To give an example of the debt that we're sourcing, We're using export credit agencies. They were developed back in the last global pandemic in the Spanish flu, just after World War I. And it was specifically so that developed countries could put their equipment and their technologies and their services to work in less developed countries. They're still doing that. We've been able to source that for development on our projects in Argentina. And given that the world is now concerned about inflation and therefore rising interest rates, the fact that we can lock in 11-year debt with a total weighted average cost of capital that we expect will be less than 3%, that's going to be revolutionary, because as lithium pricing go up, that means that not only can we service that debt and pay for it, but the free cash flow on top of that provides the company and the shareholders optionality to other things. If we used the pricing that we're expecting to come out in January, if we plug $40,000 a ton into our financial model, that would mean that we would make in free cash flow our entire market cap in 1 year. And with an expansion case, twice that. So if you're concerned about a company being overvalued or other lithium companies being overvalued, look at where some of the pricing is now. It's taking a while for brokers and others to catch up, but there's some real opportunities. So we're going to be saying more about the debt providers. They were recently on site, or at least a due diligence panel. And I have to say, not only did they speak to local communities, local regulators, but they were absolutely flabbergasted at the sheer scale of the project. I grew up on a farm. I said, 75,000 hectares, that's a big block of land. They said, yes, but you look at it on a map, it's the same sort of PowerPoint presentation. It's only when you come out here, you stand next to a four-wheel drive, and pretty much everywhere you look is the project. They were very impressed at the scale and the upside that's there. You've heard me speak previously about Offtake. Naturally, we'll be coming out with 1 or 2 offtake agreements in the new year 2022, but it won't be straight away. And you should actually thank us for doing that, because some companies have locked up offtake now, and that's going to be in backward-looking pricing. We're trying to get a rise and fall pricing matrix in our offtake agreements, and because of the scarcity of new supply coming to market, we're able to get the right partners and then to get the right commercial terms. So we don't want to just sign up with 1, we'd rather have 2. We'd like to have somebody with new technologies as well as a very well-known name. You've heard me mention before, we're trying to have a 3-way agreement between EV makers and battery and cathode makers. So expect some of that, but not straight away, probably closer to mid-year as we come out with our DFS and financial close. You will see our demonstration plant on site. Equity and debt investors are going to like that, because they can actually come up, see it and touch it. I was fortunate when New South Wales and Sydney opened its international borders recently in early November. I was able to go to London, catch up with our potential bankers. And I have to say, I was floored at how positive they were towards us and the encouragement they provided. Then to go to San Francisco and see our demonstration plant being built into 4 60-foot containers. And look, it's taking a little bit longer than we had thought, but the beautiful thing is it's now containerized. So these almost become like a plug and play. So when you see the 4 containers on site, essentially at a full production scale, there's just going to be more containers side by side inside a warehouse. So it was really encouraging to see that Lilac have put the money that they recently raised to work. All right, so that takes us through to the middle of the year, maybe into Q3. Then we'll be announcing EPCM contractors. So they're the people who actually go and source the equipment, build the plant. Prior to that, we'll probably be sourcing long lead items, because at the moment our concern has moved from financing or offtake partners. It's actually moved to execution. We've been hiring new people. We'll be hiring more people into our executive team and on site to deliver both this project and then the next projects. And on the next projects, you're going to be hearing more about us drilling through the Argentine summits, the same as the Australian summer, more rigs on our other 3 projects, because the demand is there, the equity markets are open, and the debt markets are prepared to provide what we're after. So with those 3 things, what's left is just the engineering, the delivery, some of the technical information. So we're keen to now cookie cut what we're doing with our pre-feasibility study and definitive feasibility study on the next projects. And the beauty of where these other 3 projects are, there's already solar PV farms there that could potentially be expanded. So we can actually bring those projects to market more quickly. What does all that mean? By the time we get to mid next year, Q3 next year, regardless if you've been following this story or not, the market will finally see that Lake Resources is going to be a top 5 global lithium producer. And given that Orocobre, now called Allkem, are producing about 16,000 tonnes a year at the moment. Our nearest neighbour, Livent, near our Kachi project, they're producing 16,500 tonnes per annum. They both have 4 or 5 billion US market values. So we should at least have that in 3 years' time in production, and probably a whole lot more. So watch this space. There's plenty coming down the pipe. I'm sorry that sometimes it takes a little longer. We do need to get all of our technical ducks in a row, but I've been absolutely thrilled at the support we're getting both on the finance side and furthermore in Argentina. We don't talk much about Argentina. It is a roller coaster of a ride in Argentina, but I have to say that the support we're getting at a federal government level, at a provincial government level, at a local community level is really, it's been quite strong. Naturally, there'll be speed bumps. I can't tell you that any project I've ever worked on, there's always some issues, but there's a real urge to see these projects come to market. And I can't tell you how thrilled I am just to be involved in this and this whole energy transition. It's a generational change. It's going to change the way we live. And for those of you that invest in Lake, we get to actually share and view that whole transition in real time. It's exciting.
The modular approach and then the ultimate scalability that unlocks is a really fascinating opportunity. I'd love just to spend a little bit of time continuing to focus on that DFS. So much of, particularly the next 6 months, is going to surround that. We obviously know with the uplift in the prices of lithium over the past period, some of the prices that were plugged into that PFS have risen rapidly, just to say the absolute least. So we'd be keen to hear your thoughts on the DFS, what investors should be looking for, especially the difference between the PFS and the DFS, and also just reflecting on the fact that with those low interest rates, the amount of cash flow potentially that could flow through from that EBIT line is quite an interesting opportunity too.
If I could just summarize it like this, the work that Lilac has done to date continues to be reinforced, so we don't anticipate any major changes on the PFS there. The drilling continues to support both the current resource and therefore a reserve statement plus an expansion. So we don't see any issues there. And in the DFS, you could reasonably expect phase 1 at 25,000 tonnes per annum, and then phase 2 at 50,000 tonnes per annum. What you will see that's different is the provision of power. You've heard me mention before that we're going to put a solar farm on site. We had been looking at having that together with some gas. We may still do that, or we may actually look to somehow connect with the national grid, and then the project really does become quite robust. But that'll be a timing issue. But the advantage of solar power is that not only does it provide renewable energy and a better carbon footprint, but it also lowers the operating cost line. So perhaps with this pricing, you won't really see it. It'll be like a drop in the ocean. The pricing that we've used in our PFS, when we refreshed that in March this year, we used $15,500 a tonne for high premium lithium carbonate. As I mentioned before, if we put in 40, for example, not even the EBITDA line, just the free cash flow after debt servicing and operating costs is the equivalent to our market value now for 1 year. And this is a 25-year project plus. Even with an expansion, we could probably go again. It's just a massive swimming pool of brine, and we're down in one corner. So, and we're fortunate with this particular project that the aquifer or the aquifers are predominantly sand-based, and that means that you can pump at a very high rate and also re-inject at a high rate without too many concerns. That's just a geological benefit of the particular project. So it's, I mean, I don't want to over-egg it, but the benefit of of a long-dated, low-cost debt, I just can't overstate the benefit that brings. That brings to being able to financing the project. We get 2 sovereign nations supporting Little Lake in developing this project. It means that we can bring in equipment from offshore as well as engender local community support and local businesses to participate in the development of this project and the next one. It's a real opportunity to do something generally beneficial for local communities, as well as producing a better product for this whole energy transition.
And we spoke about it there in terms of the resource upgrade. So it looks like there'll be a phase 1 and 2, potentially up to that 50,000 TPA. Interested to hear about your thoughts about the ultimate scalability from there, whether it's new projects or maybe even expanding the initial projects. How are you thinking about that, and how should we look at that moving forward?
That may be somewhat driven by the offtake arrangements. So I think you've heard me mention before, the expansion case or the second train could well be lithium hydroxide. We'll probably come out with a study saying that it's lithium carbonate, but we will include the optionality to change that to hydroxide, depending on really what our off-takers want. The thing is, with lithium, you've got to sit in the pocket of your end user, make certain that you're producing what they want now, what they think they want in 5 years' time, and with an eye to having a blend, a product mix that could change if the market changes. But once you're in production, it becomes incrementally easier to do that. And so that's on the Kachi project. I think it's probably best if we get that underway and we get at least a second project or a third project separately underway. That delivers greater value to the shareholders, even though you're putting up more equity, because they can see that you can become a multi-asset producer. And we're quite keen in the medium term to look at longer term strategic alliances, whether that's in processing technology, whether that's in cathode or battery technologies, so that we become entrenched into the whole supply chain for electric vehicles, offering a more holistic solution. And once you become part of that, then if technologies change or what have you, you can adapt to suit because you're a major player. But no, there's some really exciting opportunities, and we've been doing strategy sessions to actually talk about that, to think about how we want to look when we're at financial close in the middle of next year, how we want to look in 3 years' time at the initiation of production, and what other projects we should be actively developing so that we can seize the day, because the opportunity is right now. You've heard me say previously that we specifically had targeted 2024 for production because 24, 25 had been flagged for some time as where demand massively separated from supply. Maybe that's come forward a little bit, but anybody who can actually deliver a meaningful supply that's scalable into that gap, they're going to become major companies of the future.
I just want to spend a little bit of time thinking about that actual demand. I know that in Australia, we probably read a lot of the articles, we see a lot of the discussions surrounding EV adoption, but it hasn't really hit in Australia in comparison to some of the other nations. You spend a lot of time talking to whether it's manufacturers or people within the field. Can you speak about that demand and how other companies are thinking about it and how it really is starting to play out?
So when we have discussions with investors and with companies in Europe, they really understand what we're about. they know the benefit of ESG and better social outcomes, lower carbon. There's a financial penalty if they don't deliver on lower carbon now. That's not flowing into pricing yet, but it's certainly flowing into the selection of the products that they want. And I think it's salutary to note that BMW has just announced increased supply from our nearest neighbor in Argentina, from Livent. And that's because Livent has pushed the sustainability angle. Our process uses far less water from our analysis. It has a smaller footprint. And so we think that we can better that. Not that there's anything wrong with Livent, but when it comes to providing a product and doing that in a way that really suits the end users, that's important. Be that as it may, the electric vehicle makers and the battery makers in Europe are very much focused on their own business. If you're an EV maker, let's say you're a traditional automaker, in the past, everybody came to you. Everybody in the past just came to you with all the stuff. With electric vehicles, it's turned on its head. You essentially have a shell, and yes, each EV maker can define the look of the body. But underneath that body, there's one or two electric motors. There's a battery pack underneath, which could come from a variety of places. The software is important. And so the automakers are focused on getting the next lot of EVs designed and out the door together with the best software, and looking at the right sort of battery pack to go with that so they can go further and have shorter charge times. Then still not really focused on the issues that could come to play where the batteries don't have product or don't have materials going into them. And the battery makers, unfortunately, are signing up deals because they also feel to a certain extent, oh, that product will be there. For the first time, I would say in the last couple of months, I think the penny's dropping. And we're seeing that with lithium pricing increasing. And we'll probably see it with other battery metals as well. But you can't just take your pickup down to the corner hardware store and load up a few more bags of lithium carbonate. It's just not going to be like that. And it's exciting for us, but it's also a warning. And I think we're going to hear more about that in 2022. As we move across to the US, there the focus has been more on trying to work out exactly how they would like to see the development in the future. Who would be the strategic partners, where they would build battery plants, can they get government assistance in that process? And I think we'll see more of that. The line for government assistance in Europe is quite well worn. It's a little less worn in the US. They're also looking for diversity of supply and trying to find supply routes that don't only include China. China will continue to dominate the sector. It produces 80 to 85% of the batteries now and electric vehicles, and will continue in the future. There's no change in sight. They have a stranglehold on anode and cathode supply, and it's going to take a while to change that. But the great thing is that China very soon will be the largest economy, and so it's probably just as well that they're also focused on electric vehicles and on renewable energy. So that's how we're seeing the world at the moment, and I think you will hear more and more about upstream battery material supply bottlenecks in the new year. We've heard a little bit about it this year, and we've seen some pricing increases, but I think you're going to hear more about that next year.
I know we have touched on it throughout some of the questions, but it would be remiss of me not to ask about the offtakes themselves. You've been advantaged, obviously, by having that rising price over time. We'd love to just know about who are those types of partners you want to really partner with. I know you're looking for those longer term partners you can strategically embed yourself with. Just thinking about what investors should look for on that front over the next year.
Battery cathode makers are historically in East Asia, and they may have new production plants in North America and in Europe, the UK. So that's logically one area, whether you're talking to the battery maker or the cathode maker. Remember that the lithium, the nickel, the cobalt, the manganese, they go into the cathode side, whereas the graphite goes into the anode side. So it's logical you're going to be talking to cathode producer. But if you only talk to them, then you may be missing part of the puzzle. The electric vehicle makers really want this ESG benefit. And it's only been, I would say, in the last few months that some of the cathode and battery makers are understanding that sustainability is going to become a key driver, not just product quality and not just price. And to that end, we're seeing the cost of batteries actually go up for the very first time. They've been coming down and down and down. So we are going to see battery prices go up, and that will flow through to the consumer. We would like to get a tier 1 arrangement where there's a well-known automaker and a well-known battery or cathode maker, and I'm quite sure that we will be able to do that. We'd also like to have involved some newer technologies on the cathode side, and that may not be as newsworthy in the market, but it's important that we keep abreast of all of the latest changes. One of the issues we've had is that all of the off-takers want to buy everything that we produce. And you've heard from me before that we want to have at least 2, because that's the way you manage your business risk if you have all your eggs in one basket. I had reasonably expected to make an announcement in the latter part of 21 about that, but we are looking for a rise and fall pricing mechanism where the off-taker shares in the downside, and we share in the downside, we share in the upside, and we have a backward-looking quarterly pricing matrix. That has had some resistance. You might have seen in the market some other developers are now announcing deals where there is a rise and fall pricing mechanism. That's been hard won, and it's completely understandable. If you're a battery maker, you want to lock in as many of your input costs as possible, so you know what you're going to be selling the thing for to the car maker. But and that's why we have held off. Otherwise, we could have easily been like others and signed up something. The benefit of that uncommitted supply continues to increase in value, and I think you're going to hear more about that in the coming year.
It truly has been a jam-packed conversation. There's so many different takeaways, but I guess distilling it down, what are you most excited about moving forward, and just any final reflections for shareholders, prospective investors? What should they look forward to when thinking about ASX LKE into 2022 and beyond?
I want to thank all of the people who've been following the Lake story for their support. And if you liked the bonus option, I also thank you for your support there. We wanted to get shareholders involved early rather than just fund managers. So I thank you for that support. Some of the feedback we've had is that because the share price has improved significantly this calendar year, that the company is overvalued. And I want to deal with that head on. I do not know of valuation metrics whereby if a company can produce its entire market value in free cash flow in a single year of a 25-year operation, that is not overvalued. So if some others are saying, look, this is they've had a good run, this is overpriced, there's plenty more there. Now, naturally, as a CEO, I have to say the company's overvalued. I understand that, and you do as well. So thank you for the respect. But we're talking orders of magnitude undervalued here. Now, I understand that it's hard to know what number to plug into models going forward. You know, I have our financial model. You don't have access to that. But and it's difficult for us to work out what that number should be and what sort of volatility range. But I suspect as we go into the new year, perhaps February, March, you're going to see global brokers increase their lithium price so through that, the price targets for all of the lithium stocks are going to go up. So get in early, don't miss that opportunity. The next thing I would say is that we need all of this lithium. Benchmark Mineral Intelligence, I was just on a global presentation with them on cathodes and also on ESG. and they've come out and said that demand, excuse me, demand is running at 3 times the pace of new supply. Now, they're always fairly conservative, but this isn't going to end well. There's just not enough product coming on stream. So I think some analysts will say, oh, well, the current incumbents, the producers, can expand supply. Well, they can, but only to a limited extent. It doesn't look like there's going to be much more expanded supply coming out of Chile, despite some of the rhetoric, and we'll find out more about that as the elections wash through in Chile in the coming weeks. There will be new supply out of Argentina. I think it's probably going to be the biggest new area of supply. A number of that will be Chinese funded supply out of Argentina, but there'll be a lot of new supply out of there. On the hard rock side, we're going to see more production out of Western Australia, but only limited. So there's going to be a major shortfall. But as you've heard me say before, not all lithium is created equal. If you can produce a high quality product with an ESG benefit, you're always going to win out. It's like if I've got 5 different things that I can pick from, and one looks better, is a better quality product, delivers all of its ESG outcomes, I'm always going to preferentially select that if I can. We're going to be one of the few companies coming to market with meaningful scale, and scaling up is important. To provide some context, it was only 18 months ago, potential off-takers we were talking to were saying, can you just produce 10 or 12,000 tons and then come up to 25,000 tons? Now everybody's saying, how fast can you get to 50,000 tons, and where's the next project? So if we look back to last year, 25,000 tons was about 6 to 8% of the market. But given the size of demand, soon 25, even 50,000 tons isn't actually going to be that significant. And you've got to be significant in the market. Then as we look forward in a couple of years' time, I think you're going to see more water companies or chemical companies coming to this space, and probably some energy companies. At the moment, even though energy companies want to get involved, this whole sector is just a rounding error, but I think you're going to see more and more large companies participating, and there aren't going to be many opportunities. What does all that mean? All of that is pretty positive for Lake Resources investors. So what keeps me awake at night is just making sure we can actually deliver on this in a timely manner, that we can secure the supply that we need, because pretty much everything else is going to be there. And I really thank you for following this story. I appreciate your support, and we're looking at an absolutely cracking 2022.
It is a fascinating story. Demand continues to pick up. We know the sector continues to grow. That's the Lake Resources story there. If you did enjoy this interview, don't forget to hit the like button. Feel free to share it out. Make daily videos as well. So if you're new here, make sure you've subscribed, turn your bell notifications on. It's Lake Resources, ASX LKE. You can find them OTC as well, LLKKF. Steve, it's always a pleasure to catch up with you, mate. We're really looking forward to what is going to be a cracking 2022, as you've mentioned. Thanks so much for joining us, mate.
Thank you. Thank you for your support. Cheers.